Hello, I'm giving you the chapter summaries of our course book titled Foreign Trade. Now I'm going to talk about chapter 7. It's about foreign exchange market and foreign exchange rate. Yes, as I have mentioned, in the 7th chapter of our book, we are dealing with the foreign exchange market and foreign exchange rate. In this chapter, we are starting to the monetary aspects of international trade or monetary aspects of international economics and dealing with the international trade. Here is the chapter outline. Under the first title, we are analyzing foreign exchange market and foreign exchange rate. At the second title, we are dealing with the foreign exchange rates in the long run. And at the third title, we are analyzing the foreign exchange rates in the short run. In economics, there is a link between national and international markets as long as we are dealing with an open economy. Open economy means it is open to international trade and no restrictions on the free movement of capital. So such an economy is called open economy. This link is established by the foreign exchange market, in which the various currencies of different countries are bought and sold. Foreign exchange markets make international transactions possible by transferring the local currency to foreign currencies or vice versa. In many respects, foreign exchange markets are similar to commodity markets, but in some other respects, there are important differences. What is the foreign exchange rate? It is the price of one unit of currency in terms of the other. So foreign exchange rates are determined in the foreign exchange markets. Real exchange rate, it's different than spot or current foreign exchange rate. It is the value of a domestic currency against foreign currencies corrected for the purchasing power. In other words, real exchange rate incorporates the inflation as well, inflation of both countries. Foreign exchange rates in the long run. Fundamental economic variables like general price levels and real outputs are the basic factors affecting the level of an exchange rate. So in the long run, if you would like to know what affects the exchange rate, you should look at the general price levels and real outputs of the countries. Purchasing power parity theory claims that foreign exchange rate in the long run is solely determined by the price level changes in both countries. It is based on the law of one price. What about the foreign exchange rates in the short run? Foreign exchange rates can significantly fluctuate in the short and even in the very short run. In your daily life, I'm sure that you all realize these fluctuations in the foreign exchange rates. Even in one day, you can see fluctuations in the foreign exchange rates. So It means that it's impossible to assume or to foresee the foreign exchange rate with the purchasing power parity theory as we usually do as we usually consult in the long run. So yes, these fluctuations cannot be explained by the purchasing power parity theory, so we need some other tools, some other instruments else to explain these fluctuations in the short run. Foreign exchange rates in the short run can adequately be explained by the interest rate parity concept. So we use the interest rate parity concept in the short run if we would like to understand or if we would like to guess, if we would like to understand, we would like to guess, we would like to determine the foreign exchange rate. This is a very brief summary, of course, of our chapter 7. And I would like to remind you, as I always do, that you have lots of materials at your disposal while studying for the exams. Please refer to all of them, taking the course book in advance, of course, and try to look at all the paper tests and all the other materials. I'm sure that they will help in your success.